morning, and Assalamu alaikum, everyone. Thank you for joining us. My name is Rahim, and I will be your host for today. We have people who have joined us from across the globe, mainly from Middle East market, but we have participation from countries like America and Canada. Kindly leave your email addresses in the chat box to get industrial reports and update on our next webinar, along with what you have if you need the recording of the webinar. Some of you may remember from our previous webinar in January on sustainability, actuarial education and CBUE requirements, which was very well received by the participants. Here we are today with our another exciting webinar on ESG benchmarking by Mr. Aditya Sharma, who is from D1%, along with our second speaker, Mr. Hussain Feroz Ali, who is an actuarial consultant from DD Consulting, and he will be talking about CBUE new requirement of ORSA, own risk solvency assessment, which has a deadline of April 2024. And our final speaker will be Ms. Hira Rohani from Oasis Consulting, who will be talking about IFRS S1 and S2. So we have several important topics to be covered today. So keep sharing your questions in the chat box. Once all these three sessions are over, we will keep questions and answers. So everyone and all the questions will be answered. So let us, okay. So may I request Mr. Aditya to tell us short about their company and about ESG benchmarking and GI standards, and what are their roles in today's market for it.
Thank you, Rahim. Thank you, Senbhai, for the wonderful webinar. Really appreciate an opportunity to discuss about the ESG benchmarking and GRI standards here. Thank you, Hira, and thank you for all the other audience to join and listen us. Today, as I speak, I'm sitting in a forest, and it's my birth. So I'll try to do justice to the presentation as much as I can. And if you have any interaction, any question, please feel free to ask. I would love to have it an interactive session because we are talking about ESG, and part of E, environment, is all behind me and everywhere surrounding me. So is the screen visible, Rahim?
Yeah, it's very much visible.
Okay, great. Thank you. So about our organization, we have a vision and a motto to give back to Mother Earth. So we work on this particular vision. And today I'll tell you more about the ESG benchmarking and GRI standards, how it is important for your organization. Then after that, I'll quickly brief you about our company, about our organization. I'll keep it quick and would like more questions to come up as well if you have. So my name is Advait Sharma. You can call me Adi, and I'm going to tell you why is it important to have ESG benchmarking. So ESG benchmarking assesses the ESG performance against the industry peers or predefined standards. So let's say if there are across the industries there are several companies, then we do the benchmarking in terms of where the company is lying right now and what is the highest standard. Then we also see the benchmarking in terms of the international standards and then predefined standards. So some of the predefined standards are like GRI, SAS, and there are several other predefined standards. We will come to that. Why? Because this provides investors and stakeholders an insight into how well a company integrates sustainability into its operations and manages ESG risk. Now, a lot of you would be thinking, what is sustainability? So let me keep it quick. That sustainability is an ability to sustain for now and for future generations. ESG is a parameter where environment, social governance all together form a sustainability as a complete umbrella. So how do the benchmarking happen? There is a comparison of ESG matrix and practices with similar companies' industry benchmarks, like what are the emissions, diversity and inclusion policies, board diversity, labor practices, and community engagement. This is to give you in a zest about benchmarking. Now, if I have to break it down into a little more complex way, then environment, social, governance are the three important parameters where the scorings happen, and then ESG controversy score. So let's say if there is any rating agencies or any organizations which are checking for your investments, etc., that what are your ESG scores and how they have to benchmark, then they check your environmental categories, which are like resource use, emissions, innovations, and so on and so forth. There are like a lot of parameters. If you aggregate completely, there are 630 plus ESG matrix and 186 comparable measures used in ESG scoring. So forth in the social, workforce, human rights, community, product responsibility. In governance, it's like management, shareholders, corporate social responsibility strategy. And then ESG controversy, that your company been into any of the controversies or any of the, let's say, doing or misdoing in past, Some examples could be like oil spill, etc., or some or the other way, degradation to the environment, or let's say child labor, which happens in some countries, unfortunately. So these kind of parameters are judged, and then the scorings are done. These scorings are important, as I said, because it's kind of a scorecard that how well you are performing in the international standards and market. And at the same time, when the creditors or investors look, now they are scrutinizing it heavily on the ESG scores as well. So when we work with large corporations like the listed organizations or the government or semi-government companies, we ensure that all these parameters are ticked box in a proper way, so that the companies are doing the right thing and they are showcasing it in a right manner. There shouldn't be a misalignment. Otherwise, it may cause even greenwashing, where the work is less but shown a lot more, right? So these kind of things we have to take care so that the scorings are done correctly and it goes as per the standards. Now, why is it important? There are several things it is important because there are some peer performance insights. For example, as I told you, it drives the investments, ESG performance, and then drive internal alignment to streamline efforts, assist corporate communications on the ESG performance, and then it also guides your employee and community engagement. I remember that with one of the very good insurance companies, we have done a lot of engagement activities, and that even results into their let's say the employee satisfaction scores, or let's say retention ratios quite higher. So this is good for both internal as well as external, let's say, performance. Prioritize ESG programs and initiative, proactively respond to ESG relative investor queries, review and implement leading practices, identify unique ESG value add comparative to peers. Now, how these are compared by the rating agencies and scored. So you will see here, it's a quick one where there are several companies and how they are scored or judged as per the performance of total number of board members. This is just an example. Now, S&P is a global rating, as you would already be aware. And who are not aware, I would also tell you that there are other rating agencies like MSCI, Sustainalytics, and they take like a lot of factors, ESG factors, which impact the value drivers like growth, profitability, capital efficiency, risk exposure. To give you a quick example that how profitability is increased by ESG, because sometimes we go to like some companies invite us, and then when we discuss with them, the CEO chattingly say that how will it increases profitability when you're charging a fee, and then it's a it's a good one, but then we have to tell him that when we do a thorough analysis, then we also check what are the HVAC energy efficiencies measures, what kind of uh, um, waste measures which it could be recycled, and those go directly to profitability. For example, solar have let's say 6 years of cost, but then after that 15 years of free electricity comes up, to give you in a common layman term, you know. So those kind of things we check, and this is good for profitability, as well as the scorings and ratings. Now, what are the GRI standard? So I'm not sure how much time is it remaining. Rahim, if you can guide me, please.
Yeah,
Am I
there's,
audible?
there's you can go on with that.
Okay, perfect. So when it comes to GRI standard, it's one of the international standards, and gladly to speak about that our head office is based out of Netherlands, and GRI is also based out of Netherlands. Our HQ is in Amsterdam since 1986. So there are three important aspects to GRI standards. This is universal standard, sectorial standards, and topic standards. Now, I'll go in a little bit of technicality here. So these are modular, most widely acceptable standards, GRI standards, compatible to all companies and wide range of reporting frameworks. And these are easy to use, flexible, and clear requirements. So what are universal standards? These apply to all the three standards to your reporting. And then these comes the sector standards, which are for the sector or specific industries. Then there are topic standards, which are mainly for your material topics, like what is more important for your organization, what is less important for your organization, and you take those kind of reporting parameters and then report on the material topics. So coming back to a step back to material topics, let's come to how the GRI reporting looks like. What are the steps to it? So preparing for the GRI reporting, you have to do the materiality assessment. What is important for your organization? If I am cement industry, my priorities would be different than if I'm an insurance industry. But at the same time, we have to come together to align our ESG and sustainability parameters. So we take our materiality, we assess what is important, and then we go forward from there. We set our priorities and scope with core stakeholders. Core stakeholders as in which are our suppliers, our let's say board members, our employees, our clients, government bodies, banks, etc., financial institutions. All these comes into our stakeholders. Now then, after that, we report on the universal parameters, which are ESG indicators, which we just discussed slide before, and then sector specific. If you are in oil and gas, coal, agriculture, fisheries, then there are sector specific parameters, and then there are topic related specific parameters, which are for climate, waste, labor, occupational health and safety, etc., etc. So now I believe the previous slide would be more clear that how the GRI standards function, what are the parameters. Now, after that, assuring sustainability information, we have to choose that, what kind of information company wants to report, what not, what information do they have, what they do not have. Sometimes it could be a first report and it could be a baseline report. So you might be confused that, do I have this data? Do I have that data? That's where our expertise come up, and then we streamline the process. We tell you from starting what is important, what steps you have to take, how the data will be collected. Our team ensures the data goes in the right way, and then all these reports are searchable in the index. Have this.
Mr. Adi, I think so it's the connection issue. I think so, Mr. Adi. There's a connection issue where Mr. Adi is. So we will just wait till he joins back. Yep.
I think, Brain, we can move on to the next one, and when Adi sir
Yeah,
joins
Mr.
back.
Adi can. Yeah, we'll do that. So thank you, Mr. Adi, and we'll continue. I think so it's been stuck. So now I request Mr. Hussain to tell us a short about the company and about the deadline of ORSA and the new requirement and what is it all about.
Thank you, and thank you everyone for joining. Good morning, hello, and Assalamu alaikum. I think we have people from different parts of the world, so it would be good if you also leave your name and your location in the chat, so we have a better idea of which part of the world you are from. As our idea is that we bring more and more learning opportunities and webinar to you. So we will continue to do this, and if you have any special topic in mind where you are looking for some explanation from our side, then please feel free to also suggest that in the chat box. Let me start with giving you some overview of our webinar, of our company first. So DD Consulting is a team of qualified actuaries and accountants. We have our presence in UAE, from where we are servicing to clients in different parts of the world, such as we have clients in Saudi Arabia, Mauritius, Malaysia, etc. Our vision is to become a global consulting firm, and for that reason we have individuals within our team who are from different parts of the world and have different expertise, which helps us to support our clients by giving a diversified and versatile consulting offering. In terms of our services, so we are mainly providing appointed actuary and for peer review services in the Middle East region. Since last year or so, as we all know that IFRS 17 implementation was in progress, so we also supported a lot of clients in IFRS 17 implementation, and now a lot of you may be going through the audit process of IFRS 17 results. So, but in other countries where IFRS 17 implementation have just started, so we are also supporting our clients over there. We also do sustainability related consulting together with our partners. So you have already spoken, Mr. Adi has already given his talk. We work with Mr. Adi on sustainability reported, as well as Ms. Hira, who will come in the next session. So we work with her on IFRS S1 and S2 disclosure requirements, which is again a new global requirement, and she will be talking more about this requirement. We also support InsurTech and startup consulting. We have investment experts in our team, which helps those startups in raising funds and preparing valuation reports, doing the business valuations, etc. And we also do a lot of risk management and ORSA related work. So I'll talk about ORSA within this presentation. And lastly, we have also been working with a lot of auditors recently as their actuarial experts, and helping them in the review of IFRS 17 results. So that was a short background of our company. And now I can start on the ORSA presentation. So before I talk about ORSA, let me just take you a step back and talk about the changing dynamics of risk. Now, just if you go think of yourself in the year 2020, you would remember, I mean, I know those memories were not pleasant, but you would remember that the most important risk at that time was the pandemic risk. And 2020 and 2021 was the year where this risk dominated across the globe. So there was also a study conducted by Society of Actuaries recently, to understand the evolution of the top 5 emerging risks. And we can see in this table that 2020 and 2021 pandemic risk was number 3. However, when the same study was conducted in 2022, so war risk has taken over as one of the major emerging risks. And you can see that in the last 5 years, war risk was not there in terms of the most important risk, but directly in year 2022, it has appeared as the most important risk. So the significance of risk has been changing, and at a certain point in time, certain risk has been more important. It also depends on which jurisdiction you are living and which sector you are into. So the risk factor also changes accordingly. So if you are in a climate prone area, then climate risk will take over the priority. If you are a online or a digital insurance company, then for them a cyber risk will become the most important risk, etc. So what it requires, that whenever any company do estimation of risk, so it requires a flexible tool that can allow the company to understand the emerging risk, and to also tailor-make the tool with regards to their own circumstances. So a factor-based approach, which is traditionally popular to calculate the solvency, so that approach is still there in many parts of the world, but there was a requirement to come up with a flexible tool which can allow every company to self-assess themselves and understand their risk appetite and their risk requirements. So because of that reason, ORSA was introduced globally. The introduction has happened about 10 to 12 years back, if we look at the history. So one can ask, like, why is ORSA required, or what advantages do we get by implementation of ORSA? So obviously ORSA is now a mandatory requirement from this year in the UAE market. So you need it for compliance purposes. But on a broader scale, what can companies achieve by implementing own risk solvency assessment framework? So the number one advantage, in my view, is financial system stability. So what it means that now we live in a world which is very well interconnected. So any issue with one company has an impact on other countries or other companies and other sector, and this become an issue on a broader scale. So no other company is immune to the risk of one single entity. So we live in a very interconnected world. So it is important for the stability of financial system that every company self-assess their own requirements and ensure that they fully understand their requirements, because when the financial system will only remain stable when there is stability across the whole across individual companies. Number two, I would say, is policyholder security. So because we for insurance companies, policyholder security is the number one priority, and it is important that insurance companies are able to pay claims whenever it is due. So a lot of planning and projections are required for this purpose. So ORSA allows companies to do the what if analysis, to check in terms of scenario that if this happens, what will be the impact on it. For example, when the pandemic came, so companies could check what can be the likely future claims in such scenarios, and obviously a lot of assumptions are required, but at least this tool has the flexibility to do all the calculations. Then the third advantage is risk oversight and supervision. So the ultimate idea is that the board takes the ownership and the responsibility for underlying risk. So in this ORSA implementation process, now in fact one should remember that ORSA is a component of enterprise risk management. So the whole process is ERM, and ORSA is one part of it. So when you implement the whole risk management process, so this allows the board of directors to have a risk oversight and supervision. And you need to do a lot of risk planning, risk monitoring, and risk reporting to board of directors, so that they remain ultimately responsible and they can take timely actions wherever required. Then also informed decision making, it will help, because whether it's a decision to introduce a new product in a market or to enter into a new market, so ORSA is a tool that can allow companies to understand the capital requirements from those decisions, and they can take appropriate decisions accordingly. And when you do all of that, so it helps in building market confidence in the sector. So now we move on. As I mentioned, that ORSA is not a new name. It has been in implementation across the globe, and for the last 10 years, different parts of the world has been implementing ORSA in different phase-wise manner. So it's a small animation that we have prepared to show you how the ORSA started from one country and what is the stage of implementation across different countries. So we'll just take you on a flight for a few seconds and show you how the implementation has progressed. Sorry, I'll just open this music as well. Okay. So as we can see that across the globe, many countries have implemented ORSA, and there is a lot of learning that we can have on how they implemented, and after implementation, what were the future steps taken. So those learnings will help us in a great manner when we talk about implementation in UAE market. So now I'll give you an overview of how the UAE insurance regulatory environment has evolved. So some of you may remember that the financial regulation was the first important piece of regulation which was introduced, which had the requirements for reserving, pricing, and e-form, and beyond that, IFRS 9 and IFRS 17, which IFRS 9 was voluntary, adopted from 2018, but mandatory it was from 2023, and IFRS 17 go live was also year 2023. Then we had a corporate governance regulation issued last year in a phased manner. So we had the first submission in June, and then December, and now this year in April we have submission due. So this corporate governance regulation is in place. In terms of risk management framework, the first comprehensive one came last year, which introduced multiple requirements, whether it was the requirement to have a risk function or a separate actuarial function, etc. And as part of that, even ORSA was introduced as part of the risk management framework. And now we have, I think, recovery planning regulation, which is recently introduced. Some of us would remember that earlier recovery planning report was required from companies which had solvency problems, but now from this year, every company will have to do reporting for recovery planning standard. And finally, climate risk regulation has been introduced for insurance companies in December. I think, as I told you, that certain emerging risks are more important in different time and in different jurisdictions. So UAE has taken a number of initiatives after organizing COP28 last year. And one of the first one that I saw was the introduction of climate risk framework in December. So this climate risk will become a high priority in terms of planning as well as in terms of determination of the impact. And this will also fall part of the calculation for ORSA requirement. Okay, so now let's move on to understand how ORSA will be implemented in UAE. So as this will be the first time implementation, and there has been some guidance provided by Central Bank UAE that will obviously become the first point of reference. And then we some of our clients where we are working in implementation in implementing ORSA, we are also taking reference from other parts of the world and applying the best practices over here, where we see a lot of judgment is required. So to begin with, the first step for any company would be to do a current state analysis and to understand at what stage they are standing. What is the risk planning level that they have done so far? Then they will need to do make risk policies and risk registers, and this step will be important because whether a company asks the risk function owner or the CRO to prepare ORSA calculation, or whether they outsource this requirement in order to prepare risk policies and registers, a lot of collaboration would be required between company and the doer of this exercise. So it is expected that to understand the underwriting structure, the reinsurance mechanism, the culture of the company. So a lot of discussions and workshops would need to be required. This will also help to determine the risk appetite statement of the company, because you have to formally now prepare the risk appetite statement. Financial projections are already happening as part of the business plan requirement. Now they will form part of ORSA calculation, because you need to integrate how you calculate ORSA based on your financial projections. So there will be an integration of the business plan and your business strategy with the ORSA framework. Once you do the financial projections for base scenario, companies will also have to prepare scenarios and stress tests. And here, I think a tailor-made approach will be important, because every company's circumstances are different. So the regulator has allowed companies to come up with their own scenarios and with their own stresses, which are important for company-specific requirements. So this is one part of ORSA which can help companies understand their business functions, understand their risk profile, because the first step would be that you would need to understand, and then only you can think of the scenarios that can be of significant and material impact when those scenarios are triggered. And for every scenario, the company will have to come up with the capital requirements. Now here, you would all know that in UAE there is currently already a solvency framework applicable, which is the e-form framework provided by the central bank. So that will continue to play in future also, and the reporting will have to be done as per the old requirements. For ORSA calculations, companies will have to prepare their internal capital model, which will be a very technical exercise. Companies will have to understand their circumstances and come up with a capital model that is best suited for their operations, and the capital requirements for the base scenario as well as for the stress test that company will perform. So everything will be based on the internal capital model that company come up with. So here I'll give you an overview of the internal capital model. So generally, companies will have a choice whether they go with a deterministic approach or whether they go with a stochastic approach. and both will have their advantages and disadvantages, and they will have their complexities required. It will also depend on the underlying data available, but on a higher level, the four categories of risk is insurance risk, market risk, credit risk, and operational risk that would need to be modeled. And underlying these four categories, you have subcategories of risk, such as underwriting risk that falls under insurance risk. So companies will have to model the internal capital model in a way that can capture all these requirements. Okay. Now, because this is the first time, so I thought I also include the implementation challenges that, as insurer, most of you, if you have already started, what could be the challenges that you can face? The first one, in my view, would be the data availability and quality. So, because this is the first time standard, a lot of calculations that you need to do in this process, the data may not be already captured, or if it is captured, it may not be credible enough to allow those calculations. So that will be one challenge that you can see, and data challenge is also applicable for your stochastic versus deterministic model choice, because the more data you have, the more complex calculation you can do. Secondly is the resource intensiveness. So you would obviously need to dedicate a team for ORSA calculations, and or you have to appoint a third-party consultant. So this will require spending your resources, human resource or financial resources. Then the complexity of the risk model. So there is a choice given. No model is prescribed at the moment. So companies can use deterministic or other approaches. But if we take the example of other jurisdictions, like more developed jurisdictions, so the regulator will generally audit the underlying internal capital model that is used for ORSA. So it is also likely that in future there may be the regulatory audit requirement for this. It is not at the moment, but I'm just referring from the other jurisdiction. Similarly, there will be integration of business processes and business plans that I already talked about, that the financial projections and the business plan the companies are currently making. So those will need to be defined in a more comprehensive manner, because you will be requiring more granular level of information, so that you can integrate the ORSA framework within the business strategy framework. So for that, it will be a challenge to do some more work for business strategy and projections document. Then you have to think of your scenario and stress testing which are relevant to your company operations. So again, there is a choice given, but companies will have to think of scenarios which are specific and of material impact for the company operation, and companies will have to check the capital required when those scenarios are kicked in. And lastly, I would say communication and training. So the board of directors are playing a very big role in ORSA implementation and taking the ownership of the risk management framework. So companies will have to do some training, and so that they can do regular monitoring of regular reporting of the results. So a training of the board and senior management would be required to understand the ORSA framework, so that regular reporting starts and all the stakeholders can take timely decisions when the reporting has started. I would say lastly, I will cover the ORSA implementation requirements. So now, if you are a company that has just started the ORSA calculations and has just started to work on it, so what are the 4 or 5 top items that you need to have in your list? So first is that it will require board ownership. So obviously, you would need to inform your board that this framework has been introduced, and board will be playing a very big role in the implementation of the exercise. So the communication with the board should be started as early as possible, and they would need to be informed on a timely manner. Risk management framework. So it is a given for ORSA because ORSA is a component of the ERM exercise. So companies need to have a comprehensive risk management framework. If companies are missing that comprehensive framework, then that will be the additional project that the company will have to do, because we would need to remember that ORSA is applicable for all companies in UAE. So that's why as part of implementation of ORSA, companies will need to have a risk management framework already in place. Then the business planning document, as I mentioned, that it is already a requirement for companies and everybody would already be doing it. But with ORSA implementation, every company will have to do it in a more comprehensive manner so that the business plan can be integrated with the ORSA framework. Stress testing scenarios, as I said, companies will have to come up with stresses which are important for their own functions. And finally, the documentation and reporting to the board will be important for this exercise. So that was all from my side for ORSA. Hope it gives you some important information. The deadline is 30th April 2024. So it is very tough and very challenging, given that companies are already busy with implementation of IFRS 17 and year-end closing, as well as other regulatory requirements. But the sooner the companies can start working on it, the better it would be. And I'll be happy if you have any questions. You can leave it in the chat. We can take the questions once all the three speakers are done. Thank you.
Thank you so much, Mr. Hussain. Thank you for updating about the new requirements and the step which is required to take in this purpose and the issues related to it. And the presentation on the ORSA from the time it started till the end, it was very nice and interesting. We have Mr. Adi back with us. So Mr. Adi, back to you.
I think we are unable to hear.
Yes, Ms. Adi, if you can close your the video, maybe then it will be done. Yeah. I think so. We're still facing.
We can maybe do the third one.
Yeah, no problem. We will carry on with Ms. Hira. Ms. Hira, can you tell us short about your company and also on IFRS S1 and S2 and why they need it, why everyone requires it in today's market? Can we know a little bit about it from you?
Thank you, Rahim. Thank you very much for sure. And thank you, San and Adi, for the insights. And I hope to hear more from Adi as well. It was very informative information for me. So let's move to my presentation, and I'll tell you why IFRS 1 and 2 is important. Rahim, can you confirm me if my screen is visible?
Yes, we can see your screen.
Okay, so I'm on slide 1. So all of us know that there are a lot of sustainability standards. All of you from the audience, if they know something about sustainability or ESG, Adi has already given some information, and then there is Sam. You also shed some light on that part. So all of us know there are a lot of sustainability standards like GRI, TCFD, SASB, and there are a lot of scoring tools as well, like MSCI, Sustainalytics, and then S&P. But there was always a confusion that on which standards we need to report on. For some clients, for some investors, and for some stakeholders, one is important, and for others, the others are important. So there was always confusion for all the entities and organizations to cover everything they have to. So there is now the emergence of IFRS 1 and 2 by ISB. So IFRS Foundation has taken that lead. We are going to remove that confusion, and we are going to give something very solid that is enough for all the investors and stakeholders, shareholders to get all the information they require under the umbrella of sustainability in one place. So as we are seeing the first time adoption of IFRS 1 and IFRS 2, that's why it's very important and it's hyped right now. Everyone wants to understand what it is exactly and how we can implement and comply with all the requirements of these two standards. So we will dive deep into these standards, but I will keep it a little bit technical but not overcomplicated for everyone to understand. So yes, let's start. Starting with my company introduction, that's Oasis Consulting Group. So that's a network of consulting firms headquartered in Texas, USA. This company is established by ex-Big Four CPAs, CAs, and CFAs, and they are like their total combined experience and expertise are over 40 years. And currently, we are serving the market from USA, Middle East, and Pakistan. And the services, if I tell you about these, include risk analytics, ESG, outsourcing of highly competitive and qualified professional, and advanced IFRS solutions. So my domain is ESG and IFRS, advanced IFRS solutions under IFRS 1 and 2. The best part in ESG, if you have seen, that there is always a continuous improvement. So we have worked from carbon accounting to roadmap development, assessing the gap, helping the company in right direction. We tell them, okay, this is what you have. Every company has something they are already doing good, and they also have some negative points. So we need to have that roadmap in place for maybe 1 year, 2 year, 5 year or something, so they know what exactly is coming their way and where they are positioned right now and how they can improve their current position by doing the things step by step, because it's not something you can achieve overnight. So that's how our company, our consulting firm, help all the clients in different sectors to meet their specific requirements. What is ESG and its importance for business? So I have been seeing on LinkedIn and different platforms, people always shuffle these two words together, sustainability and ESG. So sustainability was a concept of like environmental, social, and economy. There was always focusing on three pillars. And then like 2 to 3 years back, we started hearing about ESG. ESG gives you the specific factors to focus under each umbrella, like under the umbrella of environment, under the umbrella of social, and under the umbrella of governance. If I tell you sustainability, there is simple definition as told by Adi as well, that if you have to you are consuming the resources, and you have to try your best to let those resources stay in their natural conditions and natural parameters around them for future generations to use. Like we are the way I was breathing air 20 years back, it's not the case right now. A lot has changed. The parameters are like the air quality is worse now. I can't compare it with the parameters that it was 20 years back. So everything is changing, but we need to preserve all of these for our future generations to come. That's the concept of sustainability, to sustain that situation, to sustain those conditions for the next generations to come. But what is ESG? ESG are the factors. Impact of entities, that's impact of sector specific industries, organizations, entities, or anything that is working on this earth and impacting the environment. And we can impact in different ways. We can impact the water, the air, the land, and everything. Then there is social impact. What are the social factors? When you are impacting the environment, ultimately you are impacting the society as well. In some ways we are directly impacting the society, if you are hiring people, you are impacting the society in a positive way. And if you are polluting the water, you are impacting the society, because someone in the nearby area, nearby community is going to be impacted by that. Some days they see quite a strange variety of diseases in those areas I have seen where there is a issue of polluted water. So that's how some entity or organization is impacting environmental and social parameters. But what is the role of governance? Why is governance there? Now, why is this new word ESG? That is because of governance is something that talks about the decisions. They take the decision and they want to implement, they can, and they decide about the policies, the system, the code of conduct, and everything that the industry, organization, or entity need to have in place to achieve or to work towards sustainability. So that's how the governance help in achieving the ESG factors. I'll now give you a little bit background of ISSB, and then we all know about IFRS Foundation, that is everything related to financial accounting and everything about the audited and statements. All the people who have background in finance, they know in detail about IFRS. So IFRS Foundation took the decision to establish ISSB, that is International Sustainability Standard Board, to address what? To address that confusion, the fragmented landscape of voluntary sustainability related standards, because there are so many standards to report on. They wanted to reduce that confusion and come up with something really solid that both companies and investors are good to go because there are a lot of standards, and they add cost, they add complexity, and they add risk to both the investor and the company. And there is ISSB offering us these two standards, IFRS 1 and 2, to reduce the cost and confusion. Now, if there are already a lot of standards, then why we need another standard? Because it is not like we are going to add one more standard in the existing one, then we will be reporting on all of those. No, that's not the case. We are building ISSB's aim is to build these standards to avoid to reduce the number of standards one company or one entity needs to report on. Like if you look at this, they are already offering all the sustainability related financial disclosure requirement in IFRS 1, and in IFRS 2 they are asking to report on climate change related financial disclosures. So which already like you from the terms you can assess that it is already covering a lot of different standards like CDP, if I tell you, and then there are a lot of the factors from the GRI and SSB as well, and climate related disclosure board CSD as well. So it will be more consistent, more comparable, high quality sustainability reporting, which is designed to meet investor requirements, and this is supported by these is more you can say consistent and containing all the information that is usually covered by more standards in one place. So, and here the best part is you have to give the financial disclosures as well. That is the most critical element of this standard as well, because it's difficult and it was not the practice before this that you have to in your statements you have to disclose the information related to sustainability as well, and the financial disclosures as well. So ISSB build on investor focused standards and frameworks, as it is clear from because it is developed by the IFRS Foundation. The following standards have been consolidated into the IFRS Foundation, that is Integrated Reporting, SSB Standards, Climate Disclosure Standard Board. But TCFD, IFRS Standard 1 and 2 is using the approach, the core content approach of 4 pillars, that is governance, strategy, risk management, and matrices and target. That approach it is using from TCFD. We will discuss it later. So there are two standards, IFRS 1 and IFRS 2. And why there are two standards? One talks about the journal sustainability related financial information, and second one is the first themed standard, which is about climate related disclosures. So that is the first theme because it is talking about everything related to climate. Why this is separate? In standard 1 we are already talking about all the journal sustainability requirements, and we can include the climate 1 there as well. But climate 1, climate risks are more severe. Climate risks like related to scope emissions, they're related to droughts, earthquake, and if we talk about the risk and opportunity related, like we need to put more emphasis on that, and the investors are looking for this type of information. There are always two scenarios. If there is some investor who has put some investment in your company, they request you, they require data from you on climate related disclosures, your risk opportunities, and how you are what is your strategy to cope up with those risks and opportunities because of climate risk. there is some situation where your company has invested some amount in other company and you would require them. Some days you are preparing the same information and some days you are requesting them to provide you this information. So there are both scenarios considering this, that climate related disclosures need to be put separately, and there are a lot of different sector. Like if I talk about carbon disclosure project, if you already know about that, CDP that focuses on forest, water and air quality, and where you can see in air part you will see all about all the information related to scope 1, scope 2 and scope 3. Everyone needs to give all the related information, all the risks they have identified, all the opportunities they have identified. So now just imagine if you are reporting on different standards, and for carbon simply you are reporting on CDP, that's a totally different platform, that's a totally different layout. There are a lot of questions to put answers to and then develop their strategy according to that framework. Now IFRS 1 and 2 is here to reduce that confusion, to stay and to provide everything in one place. So as I have given you the background, now I'll be moving to in details the key concept of IFRS 1, IFRS 2, and then how we can implement that. IFRS 1 is more about sustainability related risk and opportunity. It's in journal sustainability related risk and opportunity, and what we have identified in this step, it will be helping us to identify that what can affect the company's prospects, like its cash flow, assets and cost of the capital over different periods of time. We will see it over short, medium and long periods of time. So then how the process, here is an infograph, you can see it's clearly stated that we need to start with the risk and opportunities. How you assessing the materiality, because materiality is going to tell you what are the specific risk and opportunities of your specific entity organization, because these are always sector specific. Then there is one information which disclosure, like in relation to those risk and opportunities you have identified, what kind of disclosures you are going to provide. Now I have previously told you that there is a TCFD approach. Here in the green bullet you can say that's 4 pillar core content, that is governance, strategy, risk management and matrices and target. That is the approach of TCFD. Now when you have identified the disclosures you have to report in relation to your risk and opportunities, you will be using this approach to disclose the information in the connected information part. So there is IFRS 1, IFRS 2. We have discussed this is about the internal, this is about the journal requirement, this is the first thematic standard for the climate related risk and opportunities, and then SASB standards. The IFRS para 55A requires you to report on your sector specific, where applicability is available for SASB. You have to comply with the excuse me, you have to comply with the industry based SASB standard. Just give me a minute please. I'm just taking some water. Just a minute. So let's start again. Here's my screen again for you. So SASB standards tells you to when you are working on your IFRS 1 and IFRS 2, there is para 55A of IFRS 1, para 55A that requires you to use the applicability for different standards, different matrices and topics under SASB to disclose your information using that. The way we have in the previous slide, I told you that there is the thing that it has been consolidated from. It is using 3 different standards to develop IFRS 1 and IFRS 2. So that's how it uses different standards. From one, it's taking the approach, from other, it is telling you to use that information where it is relevant to your company. So that's how it's not new, but it is a new approach to implement it in a better way, in a consistent, more efficient way to get all the information under one umbrella of this disclosure, where you will be providing everything to your investors in one place. So what are the steps? The steps are very simple. As I told you, you have to first understand what you need, what are your risks and opportunities, and you will be doing the materiality assessment. And materiality is same as we have been saying in different standards. It's same in the IFRS 1 and IFRS 2. Then you will be identifying your risk and opportunity of your specific industry or sector using the materiality assessment tools or your internal processes if you have developed any, and then you will be matching your disclosures with your risk and opportunity. Okay, what kind of information you need to disclose, and which topic from the SSB or which the theme from the SSB for your specific topic you will be disclosing on. Then after that, when you have done everything and you're ready to do, you will see, okay, if there is a disclosure available, then fine. If there is no disclosure available, then you will go for the judgment and you will provide your disclosure according to that judgment. IFRS 1 uses TCFD structure to set out 4-pillar core content. That is the line which I already told you. That's the concept. IFRS 1 and 2 both are taking the information from the existing systems, but when it is taking 40% from one existing standard, 30% from one, the approach from a different standard, but the outcome is way better than all of those. When we look at them separately, okay, this is one standard, there is another standard, but when you combine that information under IFRS 1 and 2, and when you look at the information, it's the outcome is totally different from the previous, and it's better, it's consistent, it's comparable, it's sufficient for the investor than for you. Where you are headed, what you want to do, what are your risks, what are your opportunities, and how you can improve those. Connected information. There is a lot of information that is always connected within standards, and you need to understand those connections like sustainability, risk and opportunities, and then course disclosure on the core content. Risk and opportunity is always related to the disclosure, because based on your risk and opportunities, you will be identified the disclosures you want to report on, and for the disclosure you will be identifying the gaps. So that's another type of thing which is related to that information. And now sustainability is also linked with financial disclosures and financial statements, because you, for the same period of time, for the same entity, you have to provide the financial statement, and in that financial statement you need to disclose your risk and opportunity related to sustainability and climate as well. So that needs to be, that data assumption, the reporting period, and everything needs to be same in both things when you are disclosing your statements and your disclosures of the sustainability. The both things should be very well aligned. Then we have IFRS 2, because that was everything about the journal requirements and everything. You will see it is in the similar way as well as we have discussed for journal sustainability requirements. But here we are focusing more on the climate, the theme specific information, and we will be looking for the theme specific risk and opportunity, all related to climate related risk and opportunities. Now, if there is one organization or one industry that is established in UAE and there is one that is in America, both have different type of risks and opportunities. They need to do their materiality assessment. They need to identify the risk and opportunities specifically because of the climate. And once they have all that information in place, they know what is the risk and what are the opportunities of this. They can identify all the risk and opportunity, and then they can identify the disclosures they need to report on. Some areas there is very low temperature, in some areas there is very high temperature, so they need to identify what type of disclosures and risk and opportunities they have to cover, to provide information to their investors and their relevant shareholders, stakeholders, and everyone. When we have all those risk and opportunity in place, this standard also requires the companies to give information about scope 1, scope 2, and scope 3 GHG emissions. So that's how it covers CDP entirely in this disclosure. So there is one more part like targets and matrices that it covers that as well, because it is using the 4-pillar approach from TCFD. So that's how it is very well aligned, still better than the previous standards. It is the similar one like we have discussed previously. It is about how governance processes, controls, and procedures are in place to manage and to monitor the climate related risk and opportunity. The strategy is something that helps you helps you understand how you can mitigate those risks and how you can leverage those opportunities which are there because of the climate related risk. If there is something like if there is one company and their supplier is in maybe Pakistan, and Pakistan is facing floods from a few years, and if because of those floods there is some disruption in the supply chain or something like that, they need to identify how they are going to mitigate that risk. They maybe need to onboard some other supplier for maybe 30% of their supply chain. If they need to divide that proportion with some strategy that their business is not impacted because of the climate related risks. And then if there are some opportunities because of their competitors supplied in some region which is very climate prone, then leverage that opportunity using some strategy that even if their competitors' business is going to be impacted, they are in some position to still keep their supply chain aligned and not disrupted by climate related disclosures, climate related natural disasters and things. So then the next part is again risk management. That is the whole process, how they need to prioritize and monitor all the risk and opportunity. Then matrices and target, that is you need to tell over the years like how you're improving, how your targets are improving, what are the matrices in place to monitor your progress. These are the climate related risk and opportunities. In journal we can what we consider usually, that is policy, legal, policy and legal risk, market economic risks. These are the basic ones, and when we do the materiality assessment, there is much more for every specific industry, because this is something that you have to every time customize for all the different sectors, for all the different entities, and for all the different opportunities for all the companies. And for opportunities, I have also listed some related to resource efficiency. You need to improve your building, you need to improve your processes and your operational units maybe, and you can efficiently save some resource. Then there is energy source, use of low emission resources of energy, like there is solar, there are wind plants, and you can also participate in the carbon markets. Then there is something about product and services. There is a trend that every company is now having some R&D and innovation departments where they are always looking for improving their products and looking for low emission cost. And then there is another part, that is market opportunities, which is about exploring your business in new areas, new market. And here we also need to look for different standards and implementation. And the best part of IFRS 1 and 2 is it is going to be globally adopted. Here we have the SASB standards outcome, because in IFRS paragraph 55A, it tells you to use the SASB standard for your industry specific disclosures. So that's how they are 77. Why they say so? Because there are 77 industries covered by SASB standard. They have disclosures for that, so it's very nice to have those standards in place. And that's why IFRS asks you to report according to those, because these are sufficient enough, and you are good to go with those standards. But you need to put that information using these standards in IFRS 1 and 2. What are the implementation plan for this? That's one of the major questions I have always been hearing when it comes to sustainability standards. So it's about in sustainability there is always one process to start with, that is ownership. You have to coordinate with your stakeholders. You need to make them understand that okay, we have to achieve this is some agenda plan, we have to achieve this, and you need to communicate within your team first. Once you are communicating with them, you are giving them the ownership that they need to provide or work on something. Then you will define the scope. Okay, what you are going to include in this, and what facility, what entity, or you are going to be going for voluntary approach, or you want to adopt when it's mandatory. You need to identify your boundary as well and the scope as well. Then there is a readiness gap analysis. That is about the assessment of your existing position to identify the gaps in the requirements in the principle of IFRS 1 and 2 and your existing position. Then that is a very general process you need to fulfill whenever you are working to comply with any standard or any initiative which is not even mandatory, but you have to carry out this entire process. Then you need to identify your sustainability risk and opportunities for that specific IFRS 1 and IFRS 2 principles using your materiality assessment. Then you will identify the disclosures you want to report on, and then when you have now the disclosures, this is the disclosure I want to report on, it is related to climate. Now you are looking for data which is available within your organization, within your operational boundary you have selected in step 2. Let's say if there is a requirement of identifying data and disclosing data for scope 1, scope 2 and scope 3. Now what you are supposed to do, you are to look for information for scope 1, scope 2 and scope 3. And you need to identify, okay, maybe I have scope 1, scope 2, but we haven't done any assessment for scope 3. Then you will go for that process to meet the requirements of the disclosure, or you will it really depends on different situation for different companies, that how they want to proceed with that disclosure and the information. The last plan is implementation. The last step is implementation plan. It is about, because every year you have to improve. It is not about, okay, you have identified all the gaps and now on priority you are going to resolve everything. No, it's not like that. You have to make a plan. You have to implement it step by step. You will be telling at some places, okay, this is the gap we have identified, and we aim to meet this requirement by 6 years or by a span of over 1 year or maybe 2 years. Then you need to have an implementation plan at least in place to meet all those requirements. That's the entire process, and you will then repeat the things for every year, and you will know you are improving or you're not improving or where you are standing. This is the last part, like what it is and when it is going to be implemented. For the UAE, if I talk about the UAE, there is one thing that they are progressing, and they are looking towards the local endorsement of IFRS 1 and IFRS 2, because this is the first time adoption, and this year is going to be very critical, and all of the major companies, if I talk about, they are already interested in following this standard and they want to comply with it. So there is local endorsement of that, but this is going to be like a new standard, and they need help on that side, how we should prepare and how we should fulfill all the requirements of these, tailoring different sustainability reporting strategies to meet their specific needs. The best part is it aligns with the strategy, aligns with their existing sustainability practices which are currently in the EU.
Thank you so much, Ms. Hara. Thank you so much. We are, I think so, the mic has just muted off, sorry. So yeah, we are short enough of time, and sorry to cut you in. There's short enough time. So we'll just go ahead towards the question and answers. So we have some questions lined up by the people.
Rahim, sorry. As Adi is back, can you check? Adi wants to conclude something.
Hi, Mr. Adi, are you there? I think so. There's still the connection issue is still there.
Okay, then we can move to Q&A.
Okay, we'll go ahead with the questions and answers. So somebody has messaged that what emerging trends do you foresee in the field of climate risk, and how can organizations adapt their approaches to stay ahead in an ever-revolving risk landscape?
This one, I think, if Adi is there, Adi has raised hand, he can answer.
So Adi, are you?
Hi Rahim, can you hear me?
Yes, we can hear you.
My camera is off. I was earlier also there, but my camera and mic was off. If you can turn it on. Yeah. Okay, is it visible? Yeah.
Yep.
Okay. So let me just quickly go to the question. Very good questions though. I really liked it. So are we talking about the first question by Amir, or which one is it? or
Yeah,
by
by
Rahul?
Rahul. By Rahul.
Emerging trends do you foresee in the fields of climate risk? How can organizations adapt their approaches to stay ahead in an ever-evolving risk landscape? So there are different regulatory risk, of course, and then there are compliance risk and ESG risk. So the companies do have the mandatory compliance to do it. So in their ESG maturity path, they start with the regulatory compliance and then they have to move towards the next step, which is non-obligatory. And then gradually they have to take the leadership role in the sustainability reporting requirements. So let's say when we see about an insurance company and a floods in Fujairah, right? So there is a risk which is due to the climate risk, which if the companies would have already taken into account beforehand, then they would have had lesser claims. To give you an example, similarly, it could be for a company which is manufacturing X, Y, or Z, let's say fertilizer, or let's say anything. We work with so many companies on emission reduction. So regulations comes up, kicked in, and says that you have to reduce the emissions by this percentage. So that is also a climate risk because this is due to climate change. I hope I answered it quick.
There was, I think, I missed one question. As you said, from Amir. As you mentioned, ORSA is a part of ERM. So what is exactly new in ORSA? Is it like BASEL in banking industry, where there is objective calculations and rules involved to come up with objective number of capital, or is it all subjective like ERM?
I think I'll take this one because it's for ORSA. So a good question, Amir. I think just to clarify, like ERM is the whole picture and the whole story for risk management, and ERM encompasses risk registers, risk planning, and solvency calculations, etc. And one component of it the capital calculations. Now, for that, you can use different tools. Currently, the tool which is applicable in UAE is the e-form solvency model, which will continue also in future. But now we also have a new tool which is ORSA. So ORSA will allow every company to do the solvency calculation as they deem appropriate for their own circumstances. So ORSA will be part of the whole ERM process, and it will give companies another way and another perspective to look at the solvency calculations. Hope this answers.
We have another question by Amir only. How much industry readiness is there in your view? Any parallel run activity by the regulator was done or not? Is ORSA applicable in ME? Other countries like KSA, Bahrain?
Okay, so no, ORSA reporting was announced somewhere in the middle of last year, while the industry was already in the midst of IFRS 17 implementation. So there was no parallel reporting or parallel activity performed for ORSA. And this year, April 2024 is the first implementation date. So I think given the timeline challenges, so the first time implementation companies will have to do directly without doing any parallel run. And this because the year-end completion will happen somewhere in March. So it is expected that companies will have, if they haven't started already, then they will have 2 months to do ORSA completion. And in terms of other regional markets, I think ORSA is available in some form in different countries. Some companies have even adopted it voluntarily, but especially the bigger reinsurance companies. But it has yet to be adopted across the Middle East and as a uniform standard or a similar standard. So that I believe will happen over time. Thank you.
Thank you. So there is somebody who has also asked, organizations are only talking ESG as a buzzword. Organizations are still using mineral water in plastic bottles just a basic example. So in your view, do you think organizations are serious in doing something tangible?
Okay, maybe I can take this one if it's fine.
Yep.
Yeah. Okay. Yes, definitely. It's a very good question by Amir, and I like the question a lot. And that's where it has to come up to make a difference rather than just doing a compliance part of it. When we start with working with the companies, we start with doing the basic step, right? Which is like, let's say compliance. As one of the person also asked about, like, is there any regulatory requirement in UAE? Imran asked that for reporting in sustainability reporting. Yes, there is, especially for the government or listed companies, etc. And we work with a lot of them. But with them, they even don't know what is ESG risks, what are environmental factors, parameters, where they can improve. So that's where these kind of things come up, that as a next step, that how can they reduce the plastics which is circulated in their organization, and plastic going into sea, into fish, into our mouth, everywhere contaminates us as well. It's a whole cycle. So that's where we come into picture, and then tell them A, B, C, D, that how you can be compliant, B, how your operations can be better for the environment, C, how your employee well-being is important, and D, how the governance has to take all these actions and measures into the organization DNA. So I believe I have taken this particular let's say question, answered it. Maybe Rahim, I'll also quickly end up my slide, because there was just one slide remaining, and then I'll sign off from here. Can you allow me for the
Yes.
Okay. And meanwhile, of course, this is a very important part in terms of scorings and ratings too. As per the regulatory compliance, because when there are a lot of emissions,
There is one
reducing
question
it
from Hassan.
Yeah. There is one.
How
Yeah.
can investors,
Yes.
how
Yeah.
can investors incorporate ESG factor into their investment decision making process? This one and the previous one answered by Adi. I would like to add few things in here, that yes, earlier with different so many sustainability standards in place, there was something solid, like if I talk about the GRI, there are different disclosures for GRI, and they ask you about what the initiatives you are taking, what's your plan to achieve, what progress you have made, what is your performance over the previous year. But when we talk about IFRS 1 and 2, they are linking it specifically with the financial disclosures. Now you need to provide that very specific information, that the change you have created, the amount you have spent, or the technological advancement in a sustainable way. You need to provide that financial information for each of that. So yes, it will definitely help in the investment decision making process.
We have a question by Rahul. How does an insurance company offering products in engineering, marine, and aviation sectors ensure alignment with ESG principles? Especially, how does the company incorporate ESG considerations into product pricing strategies, and what criteria should it employ with selecting policy holders to maintain ESG objectives?
Adi,
would you like me to answer
this?
that? Okay,
Yeah, please.
okay, sure. So while working with the insurance companies, let's say if motor insurance is to be quoted, right? So when we see in the products and services, as the landscape is changing drastically, when there was no EV 20 years back, and then now there are like so many Teslas and all the EVs running on the roads, then it is important for the companies to definitely switch to more sustainable and ESG kind of principles for their own product matrix too. and that is included on their engineering, marine, aviation sectors as well. Imagine there is an engineering company, or let's say there is a manufacturing company, want to have the solar energy done, right? So that's where their engineering products have to be redefined. Or let's say even in the marine sector, when there is challenges of oil spill or emissions into the water, they have to change the product mix as well. They have to scrutinize the clients, as well as they have to come up with a unique product offering, which will be important for their future business, I would say.
Okay, there's a message from Kurat. How does an ORSA contribute to the overall financial stability and resilience of an insurance company?
So I think like for every regulatory requirement, one side is the compliance side that you have to do it for compliance purposes. But the bigger side is ORSA can allow companies to take informed decisions. So ORSA is a very flexible tool, and in order to implement ORSA, companies need to understand their business operations, their product lines more strongly. They need to have a better visibility of what kind of products they intend to write, what is their business strategy going forward, because ORSA is a forward-looking view of your capital requirements. So if ORSA is implemented properly, companies can take the capital involved in any of their strategic decisions. So for example, if a company wants to change reinsurance arrangement from quota share to XOL, so ORSA calculations and the scenarios will allow the company to understand the likely impact of the capital, because if you increase your retention, then you are more exposed to the underlying risk. So what is the impact and what is the capital that you need to set aside if you retain those risks? Because there is always a risk-reward trade-off. So if you have a profitable line and you intend to increase your retention, but this will lead to increase in your capital requirements. So ORSA calculations, if done properly, can allow companies to do a lot more. And if hopefully the companies will see this as the positive side, because if it is taken in a compliance-driven manner, then a lot of positives that companies can get while implementing the ORSA calculation can be ignored. Okay, thank you.
Yeah, there's another question. I think so. It's for Ms. Hira. Is there any reporting requirements to submit ESG report by the regulator in UAE? Especially it's for IFRS S1 and S2.
Okay, this is for now. For now, I'll say no, because this is the first year of reporting. It's the first year of adoption. So by the end of this year, there will be the mandatory reporting requirement depending on the global adoption. Like we are just monitoring the global adoption pattern right now, but the companies are already working to prepare themselves to be ready when it's mandatory, to have enough information, because it is going to be linking and directly linked with your statements, your accounting statements. So that creates a impact for you, because your investors are going to take decision based on these. So this is the period to prepare yourself for the compliance.
Thank you, Rag. So thank you, everyone. Please share your email address so we can share with you the recording. And kindly note, our next webinar will be on InsurTech, crypto market, and startup valuations. So be connected on our LinkedIn page, DD Consulting, for more updates on the webinar. Thank you, everyone. Thank you for